Hey guys, I just want to talk to you a little bit about actually a scenario that I've experienced fairly recently and hopefully can kind of turn it into a teachable moment. In the mortgage world, and the general assumption from buyers is that the more money that you put down on a mortgage, the cheaper your monthly payment will be. And that's a good general rule, but it doesn't always hold true. And I had a buyer who recently actually went. They didn't end up using me, and as a result, they ended up substantially overpaying in their total cash to close, and at the end of the day, didn't benefit because they got bad mortgage advice. And so basically, they got sold a bill of goods from one of the big tract builders. They're a nationwide builder, and I don't necessarily want to throw them under the bus, but builders will often do use very, very similar tactics in the way that they sell their houses and combine that with their preferred mortgage lender. So let's just kind of jump right into it. Hopefully, in a couple of minutes, you'll be able to see exactly what I'm talking about. So let's take a look here. Okay, we have the first scenario is a $302,000 purchase with 10% down. Scenario 2 is that same exact deal, but with only 5% down instead of 10. And then we also have this third scenario, which I'll get into in a minute, on scenario 3. So first scenario, borrower puts 10% down. They have a roughly $72,000 loan amount. They get a great interest rate, 30-year mortgage, and an associated 0.17% mortgage insurance factor. And the reason they got such a low mortgage insurance premium is because they put 10% down. Okay. Now, with that, and I actually ran pricing for this afternoon. So this is accurate pricing based on a 760 credit score, based on not all, but one of our investors that we place mortgages with on the wholesale channel. So with this rate and with this mortgage insurance factor, we had a $9.99 underwriting fee, and then they actually got $307 back. Okay, so we're not taking into account any sort of real estate taxes or homeowners insurance, because that just is what it is, right? Depending on what taxing jurisdiction you're in, your property taxes are what they are. They don't have anything to do with us. Same thing goes for your homeowners insurance. Assuming that you have adequate coverage, which you'll obviously need, you can choose whatever insurance provider you want. It factors into your payment, but it doesn't have anything to do with what mortgage company you choose, okay? So I went ahead and excluded that from the monthly payment, okay? So what happens then? Well, over the life of the loan, you pay almost $200,000 in interest. So that's a fun little fact, right? You pay almost as much, like roughly 2/3 the amount of interest as your overall principal reduction over the life of the loan, and that's just financing at its finest, right? That's where banks make their money, and it is just, unfortunately, it's just a cost of doing business, but it's something that you need to pay attention to. Okay, so with that said, we go through these basic closing costs, right? We don't have anything to do with taxes and insurance and escrows and stuff, but these are just like basic generic, consistently applicable closing costs, right? So whenever we scroll down, we see that we have closing costs of just a shade under $4,000, and we've got a $30,000 down payment, right? So your out the door cost without factoring in taxes and insurance is $34,000, right? With 10% down. Now, let's take a look at scenario 2. So now we have a 5% down home loan, right? Still on a 30-year mortgage, same interest rate. We have a slightly higher mortgage insurance factor because we're only putting 5% down instead of 10, and so investors deem that to be slightly riskier, right? Because there's less equity in that property, and so you have a higher mortgage insurance factor. You also have a slightly higher monthly mortgage payment, simply because you're also financing $15,000 more, right, on your overall loan amount over the course of 30 years, right? So we see, as a result of financing slightly more, we see that there's a slightly more interest paid over the life of the loan, right? And so we say, well, of course, then if that's the case, of course, putting more money down is the way to go, Okay. Now, if we keep scrolling down, we see that our total out the door cost without factoring in taxes and insurance is a shade under $19,000, right? So that just comes down to the down payment, right? Everything else is pretty consistent. So what if we took some of the money that we were going to use as a down payment and we actually bought that interest rate lower? What would that do? What if we could reduce our monthly payment? We could reduce our total interest paid over the life of the loan, and we could reduce our total closing costs. So let's take a look at scenario 3. We have the same purchase price. We have the same percent down. We have a 3.25% interest rate because we spent $7,000 to buy that rate down. Okay? Same mortgage insurance factor as scenario 2, because again, we're still only putting 5% down, as you can see here. But because we bought that rate down so far, over the life of the loan, we're only paying, relatively speaking, we're paying $162,500 and some change dollars in interest over the life of the loan, right? So substantially less interest over the course of a 30-year period. Now, what does that do to our closing costs out the door? Well, we obviously have higher closing costs, right? Because we have this $7,000 that we just used to buy our interest rate down, right? But our down payment is only $15,000 instead of $30,000, right? That's the difference between a 5% down payment on a $300,000 house. So what does that do to our payment? Well, even factoring in the mortgage insurance, even factoring in the higher loan balance, our monthly payment is less every month. We spend less money in interest over the life of the loan, and our total money out the door at the end of the day is the difference between these two numbers, which is $7,741, right? So you need to be very, very careful when someone says, well, putting more money down is going to make your payment lower. Without factoring in any other factors, that would be true, right? But if you reallocated some of that money, you might find that you win in both ways. And I'll, in the next video, I'll go into how not my client, didn't end up being my client, but how this person ended up getting kind of hosed by the builder because the agent and the builder did not go over this with her. Okay, so in part 2, we'll go over that. But this is just food for thought as you are considering buying a home. Hope that helps.